What is futures trading? Futures trading is the buying and selling of standardized financial contracts called futures contracts, where two parties agree to buy or sell an asset at a predetermined price on a specific future date. Unlike spot trading, where you buy the asset immediately, futures trading is based on a contract, not direct ownership of the asset. A futures contract includes the underlying asset, Bitcoin, gold, oil, S&P 500, etc., the contract size, the expiration date, except perpetual futures, the agreed price. The key idea, you're trading the price movement, not the asset itself. Where are futures traded? Futures are traded on regulated exchanges such as the Chicago Mercantile Exchange, CME, Intercontinental Exchange, ICE. In crypto markets, futures are traded on platforms like Binance, Bybit, OKEX. Types of futures contracts. A. Traditional futures with expiry. These contracts expire on a specific date. On expiration, the contract is settled, cash or physical delivery. Traders must close or roll over positions. Example, oil futures expiring in March. B. Perpetual futures, perps. Common in crypto trading. They have no expiration date, use a funding rate mechanism to keep price close to the spot market. Most crypto traders use perpetual futures. Long versus short in futures. One of the biggest advantages of futures trading is the ability to profit in both directions. Going long, you buy a futures contract expecting price to rise. If price goes up, you profit. Going short, you sell a futures contract expecting price to fall. If price goes down, you profit. This makes futures powerful during bear markets. Leverage in futures trading. Futures allow leverage, meaning you can control a larger position with a smaller amount of capital. Example, you have $1,000. Use 10x leverage. You control a $10,000 position. If price moves 5%, profit is 50% on your capital, but loss is 50% if price moves against you. Leverage amplifies both profits and losses. Margin in futures trading. To open a leveraged position, you must deposit margin. There are two main types: initial margin, the amount required to open the trade; maintenance margin, the minimum amount required to keep the position open. If your account falls below maintenance margin, liquidation occurs. What is liquidation? It happens when your losses exceed your margin. The exchange automatically closes your position. Example, you open 20x long. Price drops 5%. Your position may be liquidated. This is why risk management is critical. Mark price versus last price. In crypto futures, last price is the current traded price. Mark price is a calculated fair price used to trigger liquidation. Liquidation is based on the mark price, not the last price. Funding rate, perpetual futures. Perpetual contracts use a funding rate to keep futures price aligned with spot price. If funding rate is positive, then longs pay shorts. If negative, shorts pay longs. Funding is exchanged every few hours, depends on platform. Why traders use futures? Profit in bull and bear markets, use leverage for capital efficiency, hedge investments, trade volatility, no need to own the asset. Risks of futures trading. High leverage, high risk. Liquidation risk, emotional trading. Funding fees, overtrading. Most beginners lose money because they use too much leverage, risk too much per trade, trade without a plan, and neglect basic risk management. basic risk management rules. Professional traders typically risk only 1 to 2% per trade, use stop-loss orders, avoid high leverage, especially beginners, trade with a plan, and control emotions. Example of a futures trade. Let's say Bitcoin price is $40,000. You open a 5x long. You invest $1,000. Position size is $5,000. If BTC rises 10%, position gains 10% equals $500. Your return is 50%. If BTC drops 10%, position loses $500, you lose 50%. This shows the power and danger of leverage. Final summary. Futures trading is a powerful financial instrument that allows traders to speculate on price movements, use leverage, profit from both rising and falling markets, but it requires strong risk management, emotional discipline, and proper understanding of leverage and liquidation. Without proper education, futures trading can quickly wipe out an account.